my faith will rise. I'm crawling out the trenches, holding me, my life.
Hello visionaries, welcome back to my channel. My name is Maresa Talbert. I'm the founder and CEO of Talbert Law Office, your favorite go-to legal resource for all things business, nonprofit, and intellectual property law. We are continuing our series on business entities, and today we're going to be talking about partnerships. You know me, I'm straight to the point, so let's jump right into it. So first we're talking about what is a partnership. A partnership is when two or more people are engaged in an activity that is intended to make a profit. If you start a lemonade stand with your 5-year-old son, congratulations, you formed a partnership. Now let's rewind for a minute.
A partnership is two or more people engaged in an activity that is intended to make profit.
And talk about who people is. In legal terms, person or people may include individuals like you and I, businesses, interest-based organizations, schools, governments, or a combination of entities. The point is that people does not have to be a single human being. So in a partnership, each person is responsible for contributing money, labor, skill, property, and shares in the profits and losses of the business. Next, let's talk about who owns a partnership. It's pretty intuitive that the owner in a partnership is called a partner. You can have a general partner or a limited partner. A general partner normally manages the day-to-day operations of the business. However, a limited partner really plays the role of an investor. You may not know this, but there are 4 different types of partnerships. There's a limited partnership, there's a general partnership, there's a limited liability partnership, and there's the limited liability limited partnership. A general partnership is the most basic type of partnership. Just like our sole proprietorship, there are no formal requirements or documentation needed to start a general partnership. And just like our earlier definition, a general partnership is automatically established when 2 or more people engage in activity intended to make a profit. Unless otherwise agreed upon in writing, ownership and profits are usually split evenly among the partners. In a general partnership, all partners have the independent power to bind the business to contracts and loans. Each partner also has total liability, which means that each partner is personally responsible for the business's debts and obligations. For example, if one of the partners takes out a loan that the business cannot pay, all the partners will be personally responsible for paying that debt. Okay, so you've been warned. The good thing is that general partnerships are easy to form, but they're also very easy to dissolve. And in most cases, the partnership automatically dissolves if one partner dies or goes bankrupt. Now let's talk about this limited partnership. Limited partnerships are formal business entities authorized by the state. They have at least one general partner who is fully responsible for the business, and one or more limited partners who provide money but do not actively engage and manage the business. You've heard people talk about a silent partner. That's the role of the limited partner in a limited partnership.
Why in the hell didn't you tell me you were going to open a restaurant?
Okay, William, I'm gonna open a restaurant.
It's too late now. I had to find out from 2 lowly junior partners. Oh, I just want nothing to do with you.
And I don't even want to be your friend anymore!
The favors you do me keep piling up. You know, if it's as good a deal as you say it is, I'm ready to move forward.
Oh, Tony, I'm so sorry I'm late. You? Please tell me that you are not my investor.
Your investor? Tony told me this place was for sale.
It's not for sale, it's for lease, isn't it, Tony? Look, you can stand here and argue about what was said to whom by an obviously confused pregnant lady, or you can work this out in a way that doesn't affect my commission. I gotta go, bye. Apparently Apparently, I've been lured here under false pretenses.
As was I. Was just looking for a good investment.
And I need an investor.
I'll be your silent partner and put up 40% of the capital right now. Handle that.
Oh, really? Well, I could handle taking 50%.
I can handle giving it to you.
Then handle it.
It's handled.
Well, then let's get it in writing.
I'll have the papers drawn up and on your desk so fast it'll make your head spin.
Oh, really? Well, I don't have a desk, so you're going to have to put the papers on my table if you can handle that.
I can handle that and buy you a desk if you can handle it.
Oh, really? I could handle it. As a matter of fact, there's a desk at Carol Kipling I could really handle.
Fine. Matching chair?
And credenza.
Bring it on!
Oh, it's brought. And you are officially an investor of Jones Tapestry.
That's stupid. It should be called the J-Spot.
The J-Spot? That's brilliant. Thank you.
My pleasure.
Good night, partner.
Good night, partner.
I still hate you.
Again, limited partners invest in the business for financial returns and are not responsible for debts and liabilities of the business. Limited partners can also share in the profits, obviously, but they cannot lose more than what they've invested in the partnership. It's important to note that if a limited partner starts to actively manage the business, they may lose their status as a limited partner, along with all of its low protections. I told you that in legal terms, a person or people could be an individual or a business entity. So some limited partnerships form an LLC to serve as the general partner so that no one has to bear unlimited personal liability for the business. That option may or may not be available in your state, and it can be quite complex. So I'm just throwing that out there for informational purposes. Now let's slide on over to talk about this limited liability partnership. This type of partnership is not available in every state, but it is specific to California, where I'm licensed. A limited liability partnership operates like a general partnership where all the partners actively manage the business, but it limits partnership liability for the negligent actions of other partners. This LLP model is often limited to certain professions, such as doctors, lawyers, engineers, and accountants. Last, and must I say least, is the limited liability limited partnership. I won't say much about this model because I really don't recommend it, but it is a newer type of partnership model that is not available in every state. It operates like a limited partnership with at least one general partner who manages the business, but it limits the general partner's liability, so all partners have limited liability. I mention it because it does exist. However, I haven't really worked with this model before, and I believe the kinks are still being worked out with how it operates in practice. So throughout this video, I've mentioned the word liability a few times already. So let's talk about it a little more directly. Unless you have formed a partnership where liability is inherently limited, all partners in a partnership are held jointly and severally liable for business debts. This means that the partnership's creditors can take action against any one partner or against all of the partners at the same time. Again, you've been warned. So now let's talk about what you might need when forming your partnership. As I've said before, the creation of a partnership can be very informal. Now, there are some types of partnerships that require a formation, but in its basic form, there are no required governing documents. That does not mean that you can skip over having a partnership agreement. A partnership agreement establishes how your partnership will run, how the profits and losses will be shared, and how you'll manage changes such as a partner leaving or dying. Just because it's not required by law does not mean it is not required. You need to have a partnership agreement. Your partnership agreement should be signed by all partners and should be kept on file within the business. Your agreement should cover the following items. Who are the partners? What is their contact information? How will ownership be divided among the partners? Who will manage the business? Will more than one partner share that responsibility? Do you have any limited partners? If so, how much money are they contributing? How will disputes be resolved? What happens if you have an irreconcilable difference? What process will you follow? If one partner leaves, how will that person's financial stake be valued and resolved? How will profits and losses be distributed? Is it on a set schedule? Is it at the partner's discretion? Will family members participate in the partnership? Will family members have any special privileges or powers or even limitations? I could go on and on and on. All of these items are very important for discussion. So get your partnership agreement done early before you get into a conflict. Okay, so you know where we're going next. We got to talk about these taxes. All right, so generally, a partnership has what is called pass-through taxation. So I talked a little bit about this last week on the sole proprietorship video. So pass-through taxation is when you report your profits and losses on your individual income tax returns. However, there are a few important forms to be aware of when you've entered into a partnership. Number one is the IRS Form 1065. This form is an informational return that the IRS reviews to ensure that each partner is reporting their income correctly. Number two is the Schedule K-1. That's reported to the IRS and to each partner. That form breaks down each partner's share of profits and losses within the business. And number three is your individual tax return, which is whatever variation of the Form 1040 that you file. It's also important to remember that your taxes are not being withheld throughout the year like it would if you were an employee. So that means you are responsible for estimating the amount of taxes that you might owe at the end of the year. And you should be making quarterly payments throughout the year to both the IRS and your state tax agency so you can stay out of trouble. Of course, you know if your taxes are not being withheld throughout the year, you're going to get hit over the head with that self-employment tax. I'm not going to keep repeating myself. You should know by now that self-employment tax is 15.3% of your income. Be ready. Be prepared. Another important thing to note in a partnership is that you are taxed on your proportional share of ownership. This is known as your distributive shares. Basically, if you own 60% of a partnership, you're going to be taxed on 60% of the profits, whether you receive that money or not. So let's just say you didn't take your cut of the profit because you wanted to leave a reserve for future expenses. You're still going to be taxed on what you were supposed to earn. It bees like that sometimes. On the other hand, let's say that you own 60% of the partnership, but you and your partner have agreed to split the profits and the losses 50-50. That's called a special allocation, which has special rules with the IRS. So be careful and be fully informed. The takeaway is, y'all don't get in trouble with the IRS. File your taxes and do so properly. And with that, I think I have given you enough information, and I'm going to wrap this video up. Let me know in the comments if you have more questions about partnerships. We're going to keep this train rolling because next week we'll be talking about LLCs, everybody's favorite business entity. And of course, as always, this is Talbert Law Office, your favorite go-to legal resource for all things business, nonprofit, and intellectual property law. I'll see you in the next video.
I done made it this far. I'ma keep it pushing, yeah. Even made it through the